The Marshmallow Test. Are you a natural-born investor? According to several studies, the marshmallow experiment is the ultimate test that predicts a person's success in life. Why? Because it measures sensitivity to delayed gratification. In other words, preference for the long term. Do you see where I'm going with this? Here, we will extrapolate this deferred gratification to investing and show how we can confront our cognitive biases to make better investments. The Marshmallow Test. Walter Miskell, a behavioral psychologist, proposed an experiment in 1972 to assess children's ability to defer a reward. The somewhat cruel experiment involved placing a marshmallow on a child's table. The child had to refrain from eating the candy if he wanted to have a second one. But for that, he had to wait 15 minutes, an eternity for a 6-year-old. 1/3 of the children resisted the temptation. Walter Miskell's team then followed these little guinea pigs for almost 30 years. The researchers observed that those who had resisted had a more successful and fulfilling social and professional life. Even if the results are debatable, the idea was to observe the strategies put in place by children to resist the call of the marshmallow. They displayed a whole bunch of cognitive biases to convince themselves to resist or to make them feel less guilty for not having resisted. This little experiment allows me to introduce a key notion in the success of an investor: deferred gratification. This is the ability of an individual to delay the receipt of a reward in order to increase its value. The concept is quite basic: the longer you wait, the more you earn. However, one should not fall into the trap of, as long as I don't sell, I don't lose, hence the importance of having quality positions in your portfolio. Deferred gratification is the opposite of one is better than two. With the marshmallow test, it's more like yours is worth less than two. But let's not get carried away, back to our topic. For an investor, this means using money that could be spent on a liability and investing it later in an asset. It is accepting a sacrifice in the present to obtain an increased profit in the future. Moreover, a researcher from the University of Pennsylvania showed in 2005 that the marshmallow test is a better predictor of success in stock market investing than the IQ score. Basically, to be a successful investor, it's better to be future-oriented than smart. Until then, all investors with enough willpower to favor their delayed gratification can succeed. If you put €100 per month on a tracker replicating a broad index like the S&P 500, you will be a winner in 100% of the cases after 25 years and in 96.3% of the cases after 10 years. And it doesn't matter when you started investing between 1912 and 2011. Except that it's nice in theory, but in reality, if we don't have a return on investment after 1, 2 or 3 years, it becomes much more difficult to maintain our optimism and belief in the rise of markets. That's when emotions kick in and make us make the worst decisions, often at the worst time. Let's take a closer look at how these decisions are made, and more precisely, how the simple fact of having the ability to choose, to buy or sell a stock for example, implies hidden cognitive biases that push us to favor the short term and thus often to make bad decisions at the wrong time. FOMO and FOBO. You are probably familiar with FOMO, which stands for fear of missing out. To choose is to select, and therefore to eliminate the other possible choices. FOMO is derived from a good intention, to want to experience everything the world has to offer. It is an ambitious attitude that leads to overactivity, or in our case, overtrading. If you are a long-term investor, you need to protect yourself from it. FOMO has a lesser-known but equally treacherous cousin, FOBO, fear of a better option. It encourages us to do nothing. We've all experienced it as we scrolled through the Netflix catalog looking for the perfect movie. In the end, we spent more time choosing a movie than watching it. In short, FOBO and FOMO illustrate two extreme attitudes that most often result in two non-choices: to do everything or nothing. That is the question. You might ask, what does this have to do with me as an investor? I'm getting to that. These cognitive biases lead you to spend more time in anticipation of the decision, which increases your expectations of the investment and also makes you less patient if the choice doesn't pan out quickly. As a result, you are more likely to take your losses at the worst possible time and be frustrated with your non-choices, bad choices. Faced with this dichotomy, we see two attitudes among investors. On the one hand, maximizers, who favor demanding decisions through a stock-picking method to select their own stocks. On the other hand, the satisfied, who favor the simplicity of decisions through passive management and asset allocation in the form of index funds. The problem is that we like to choose. Making a choice from a shortlist makes us happier because that choice will be faster and less frustrating than not choosing, FOMO, or choosing everything, FOMO. Without psychological preparation to one's own biases, these two attitudes are almost inevitable for new investors. But how can you protect yourself from these fears, biases, and bad choices while optimizing your investments? We present here some solutions. 1. Listen to the pre-selections of successful managers. Taking into account their choices is to avoid a heavy work of analysis upstream and benefit from a quality selection. Several sites also provide stock screeners to identify opportunities and evaluate the potential and quality of a company. Opportunists benefit from the best of both worlds, the high quality of the maximizes selection and the simplicity and speed of the satisfied selection. 2. Become aware of your psychological biases. Against FOMO, you just have to take the time to analyze a company and to enter in several times on its positions to average your PRU, DCA method, dollars cost average. Don't buy a stock you didn't know a week ago just because you heard about it on a discussion forum. The key to fighting FOMO is to limit your options, or even leave yourself no choice. For example, you can make automatic transfers to a diversified portfolio, without worrying about whether it's the best time to invest. Against confirmation bias, the tendency to listen only to arguments that go our way, and availability heuristics, when we overestimate the importance of some data at our disposal such as similar success stories, we need to multiply the sources of information, take the time to study a case from all angles and discuss with people outside our primary affinities who do not share our opinions. Against the overconfidence bias, which pushes us to take more risks, it is advisable to detach yourself from the present moment, take a break from the markets and analyze your risk management cold. Against the survivor bias, when we only see the examples that have succeeded but ignore all the companies that have disappeared, it is important to study the history of markets, how bubbles are created, dot-com bubble in 2000 for example, and why some stocks disappear. To counter the ripple effect, when groupthink pushes us to think like the consensus, we sometimes have to be contrarian and find counter-arguments to our own arguments. Against outcome bias, when we judge the quality of our decisions by the results we get, we can protect ourselves by keeping a log of the reasons for buying and selling our actions. Keeping track of our decision triggers allows us to focus on the right reasons to invest or sell, regardless of what the market says in the short term. Some bad reasons for investing, e.g. I'm buying a stock because my best friend bought it, will have good results. And vice versa. But over time, the right reasons, i.e. based on the fundamental qualities of the company, will win. And the king of all, the blind spot bias, when we fail to recognize our own biases. Indeed, we notice the cognitive biases of others more than our own biases. Just being aware of them reduces their power. 3. Set goals. Setting goals, and keeping them, is crucial. In fact, the way you invest differs according to the objective associated with it. Are you investing to finance a project by a deadline, to retire earlier, or more comfortably? Are you investing to leave a legacy to your grandchildren? All of these goals are different and so is the investment plan that goes with them. The idea is to set a SMART goal, which means specific. Define a specific goal, example, I want to retire at 55. Measurable, define a result indicator, example, I need to put aside X euro to achieve this. Achievable, define the intermediate steps to get there. Realistic, define the means to get there. Temporal, set a deadline. 4. Create good habits. Creating good investment habits is a direct result of the means available to achieve your goal. And acquiring a new habit is often difficult. The brain is always a little confused when faced with unfamiliar actions or reasoning. But this is where the phrase pedagogy is the art of repetition makes sense. The more you practice, the easier it gets. In investing, one way to create a good habit is to automate your payments each month, which add directly to your portfolio. In short, the idea is to pay yourself first. Investing is much easier if it is the first expense of the month. 5. Accept that you don't know. This doesn't mean you should be satisfied with not knowing. When you start a new task, you should accept your position as a beginner. And of course, to remain curious and open to everything that can improve your knowledge of the markets, history of the markets, fundamental, technical, psychological analysis, etc. 6. Measure your progress. Staying the course does not mean never questioning yourself. By taking note of the reasons for your investments, your purchases and sales, you keep a record of your psychology and will have no, or less, regret if this decision is based on a reasoned explanation, whether fundamental or technical. The idea is not to make the same mistakes twice. As you go along, your decision-making will improve. In conclusion, to the question, are you cut out for investing? I would answer that if you have made it this far, after 15 minutes of reading without eating this marshmallow, you have the right dispositions to succeed as an investor. The secret to smart investing is to prefer the future. It sounds easy to say, but in reality, it's often much more complicated to keep a distant horizon. The frenzy of our ultra-rapid daily life coupled with the irrepressible desire to consume everything, everywhere, all the time, pushes us to invest as we consume. Our agendas are overloaded and our purchases are compulsive. On the contrary, to invest is to cut oneself off from the present time in order to put it off until later. It is also to cut ourselves off from our emotions. Investing is not buying shares like buying a smartphone. We don't consume, we save for a future time. The immediate result is less important than the long-term journey. And for that, there is only one way to succeed in investing, and that is slowly.